All right. Well, I guess we'll get started this evening. Thank you so much for joining us on our 2019 Economic Update for Lending and Real Estate webinar tonight. We have a really exciting webinar tonight full of a ton of information, and we have a ton of investors signed up for tonight's webinar. So really excited to have you all on. I'm going to introduce our guest speaker here in just a moment. But I know we have a lot of new faces on the webinar tonight. So really briefly here, I'll give all of you a nice little introduction to Marshall Reddick Real Estate, who we are and what we do. Here at Marshall Reddick Real Estate, offer three primary services. Real estate.
You need to hit start broadcast. Hit it again.
The broadcast is now starting. All attendees are in listen-only mode.
Okay, Marshall Reddick investors, thank you so much for joining us this afternoon. Really excited to have you all on. We have a large turnout tonight and some great information and content for you. Before introducing our guest speaker this evening, like I said, we have a lot of new faces. So I'll go into a little bit of detail of who we are here at Marshall Reddick Real Estate and what we do. Here at Marshall Reddick Real Estate, we offer three primary services. We're a real estate brokerage, a private money lender, and a property manager. Now, real estate brokerage, what does that mean? We help our clients buy and sell here in the state of California and 16 markets across the country. Myself as an advisor work both with owner occupants to buy and sell and investors as well. We're a private money lender, so we offer private financing for our clients who'd like to utilize those types of loans for their investment property, or for our clients who would like to lend their money passively for a fixed return. And we're also a property manager, so we manage our clients' portfolios in many markets across the country. Myself, my name is Daniel. I'm a realtor and a real estate advisor here at Marshall Reddick Real Estate. I've been here for 3 years. My background's in finance, and I'm an investor myself. So in the same capacity that I work with my clients, I practice what I preach. So I'm certainly really looking forward to speaking with all of you following this webinar, answering your questions, learning more about your specific real estate and investment goals. A little bit about what I do and how I work with my clients. I use the word goal, and that's really where it starts. Learning what you're looking for, quantifying your returns, whether you're looking for cash flow and appreciation, setting a path and a plan to get there. One very important aspect of the path to get there is financing, lending, really your how. And that includes introducing you to the right people. So we're going to introduce our speaker tonight, our preferred lender, Reed, and he's one of the key people in the entire equation. But also in working with clients, one of the primary things that I'm able to do, or we do together, evaluate markets and properties that make the most sense for those goals that we had set for your specific criteria. I mentioned just a bit ago, here at Marshall Reddick Real Estate, we're in 16 markets across the country. Those markets are chosen by no accident. We have pretty stringent criteria. You can see the 7 points here. Every market that we're in, these the 7 key points that you see here are evaluated pretty extensively and researched prior to adding a market to the 16 that we're in currently. And for any one of our markets, in reviewing them together, these are all points that we discussed together as well. And they have to hit all 7 of these points to be chosen as a suitable market to invest. And what markets have we chosen and what markets have we evaluated as great investment markets? These 16 that you see in front of you here. You'll notice all across the United States of America. And the red boxes are actually our brick and mortar offices, Marshall Reddick offices, staffed with Marshall Reddick realtors, property managers, leasing agents. And then the rest of our markets, we work with vetted third-party referrals who also work directly with Marshall Reddick clients and manage large portfolios of our clients' properties. And so would love to talk a lot more with each and every one of you, like I had said, about what we do here, the markets that we're in, and what the types of properties you're looking for specifically. But tonight is really about our economic forecast for 2019. So really excited to introduce you all to our preferred lender, Reed Hazard. We've been working with Reed and his team for over 14 years, licensed in all of our markets, incredibly knowledgeable, and I think I'm just excited about tonight's event as you all are. So without further ado, I'll bring Reed on to the stage.
Thank you, Daniel, and thank you to Marshall Reddick for letting me present tonight, and thank you to all you guys for being on the call. So, yeah, we're gonna have some fun. It has been a wild few years, and we're gonna go through all that tonight. Daniel, next slide. A little bit about me. We're licensed, as Daniel said here on the bottom line. You'll see we're licensed one in California, Oregon, Nevada, Arizona, Texas, Tennessee, Indiana, Kentucky, and Florida. We also do loans in Idaho. So any of the states on the Marshall Reddick website, when you get pre-approved through us, all the processing and underwriting is done at my branch with the same team. So we try to make it feel like, many of our buyers live out here in California, which is where we're located, and we try to make it feel like you're buying a home right around the corner when you're buying with us out of state. And we've got a great program put together for you. We specialize in 1 to 4 unit property. Anything over 4 units would be considered commercial. We have good referrals for you for those types of loans. Marshall Reddick also specializes in private financing. So if you're on the website, the Marshall Reddick website, check out the new borrower tab. And go in there and see what there is to review and use as a tool. Okay, and one more thing that I want to mention, guys. I'm also an investor myself. I've been buying properties since I was 19. I'm 32 now, and so we've been doing these seminars since before the downturn, during the downturn, and then over the recovery phase over the past 5 years. So there's a lot of great literature on the Marshall Reddick website under the education tab. I recently wrote an article that is very in-depth about why rates are going up long-term. Tonight's going to be a little bit more about the past and then the present, but not really too much about the long term. And if you guys want to read that article, check it out. It'll have a lot of information about the government essentially pulling out of mortgage-backed securities and treasury bonds over the next 10 years. Okay, moving on to the next slide. So information I'm going to be covering tonight, we're going to do a historic look at interest rates. I always talk about, oh yeah, rates were 18% back in the early 80s. Well, I'm going to tell you guys why tonight. Why interest rates went up in 2018, what to expect in 2019. I'm actually going to kind of show you guys really why they went up in 16 into 17, and then what happened throughout 17, 18, and then what to expect for 2019. We actually had a federal interest rate decision today also, which is pretty cool. So I updated a lot of this information based on today's data. So there'll be a lot of information here tonight that's very up to date. We'll also be going over how our political climate is impacting markets, right? Government shutdowns, trade war. I'm going to be going into really how that's affecting markets, what factors are helping fuel the real estate market, and then how to get approved for a loan within 3 easy steps. So, okay, Daniel, next slide. Okay, so before we start, everybody needs to know, what is the federal fund rate? We all hear this term being used so commonly. Basically, the federal fund rate, the Federal Reserve is in charge of this interest rate, and it's what really sets the market. It's the federal fund rate is the rate banks charge each other to borrow. Okay, this rate is set by the Federal Reserve. This rate was 0 to 0.25% for years and years to get us back up on our feet, essentially. Okay, the Federal Reserve uses the federal fund rate as a tool to slow down inflation when the economy is heating up, and to spur growth by lowering borrowing rates when the economy slows. So this is a graph of the federal fund rate from 1955 to 2018. And if you're looking at this, you're probably going, well, maybe you were buying property back in the early 80s. My dad bought a property in Cardiff by the Sea. He said, my rate was nearly 18% for a 30-year fix. So when he sees 5.5%, he chuckles and just goes, wow, this is just incredible. But the reason why rates went that high was very different than why we're seeing them go up today, and I'm going to kind of dissect that for you. So don't be worried about rates going to 18% anytime soon. And just to kind of show you guys how the federal fund rate is relative to the 30-year fixed mortgage rate, if you see here, federal fund rate around 1981, 82, federal fund rate around 1981, 82, the 30-year fixed rate hit 18.45% for a 30-year fixed mortgage. The average, as you guys can see, is 6.67% over a 30-year period. And so obviously the returns look really good when you're about a 5.5 rate and below. They even look good when you go above that, but you'll need more money down to start getting a little bit better returns. That eats into cash on cash return, et cetera. So you guys see that's why rates are so important. Okay. So why did interest rates spike to 18% in 1981? So in 1950s was a very interesting time. Okay, we had, we had the Great Depression and the Second World War not too long before that. Okay, so central bankers had lowered interest rates to almost zero at that time to grow the economy again. Okay, it was coming out of turmoil, and so through 1950s, they began to gently raise interest rates after a period of sustained low rates, which had ran through the Great Depression to the Second World War, but they was still very, very low. 1960s brought a time of optimism and new ideas as the world economy is expanded. The standards of living also continued to rise, right? Science kind of helped with that. So there was still an easy money policy, though, that had flowed from the 50s into the 60s. So essentially what easy money means is that it's low rates fueled by a low federal fund rate. So during this time of great expansion, okay, which is what drove the market at that time, there was only modest rate increases through 1960, 1969. Okay, now you come up to 1970, okay. The biggest reason why inflation started going up in 1970 was because of the oil crisis. And I'm going to break that down on the next slide, but I'm going to read this out real quick so we can start here. So in the early 1970s, inflation began to run rampant. In America, prices were rising fast, usually thought to be the result of the oil crisis of that era, government overspending, and the self-fulfilling prophecy of higher prices leading to higher wages, which then again leads back into higher prices. Okay, so what actually happened? The 1970s energy crisis was a period when major industrial countries of the world, particularly the United States, Canada, Western Europe, Japan, Australia, and New Zealand all faced substantial petroleum shortages, okay? And it's because petroleum production peaked in those major countries. Around that time, okay, the Arab-dominated Organization of Petroleum Exporting Countries, that's known as OPEC, we all know OPEC, okay, announces a decision to cut oil exports, okay? So we already have a shortage, which is causing supply and demand to go crazy, which is driving up oil prices, okay? And remember, oil filters into everything. If the prices of oil are going up, it's a good precursor that we're going to have higher inflation in the future. Why? Because you need oil to run machines. Machines make cut wood to build houses. Machines make cars. Machines make everything. And you need oil, especially at this time. Oil was, you didn't have all these different types of energy like you have today. And even today, oil is still very, very inflationary. But even then, back then, it was like life and death, okay? So now you have OPEC come out and they decide to cut their oil exports to the United States and to other nations that provided military aid to Israel in the Yom Kippur War of October 1973. So this added pressure on oil around this time, okay, because they were essentially hoarding their oil caused the price of oil to spike dramatically. And if you come to this next slide, you guys will see that's the cost per barrel from 1967, okay, to you see right here, to 1982. I mean, it went from $10 a barrel to over 60, okay? So let's back up a little bit. Now, again, also to put this out there, you know, petroleum-rich countries like the Middle East benefited greatly from the increased prices and the slowing production in other areas of the world. So, believe it or not, when this happened, it's kind of growing areas of the world that hadn't experienced this type of growth before. So it's almost like this had to happen for some reason, but it is a Cinderella event. It doesn't happen often, and probably will never happen again in our lifetimes. Okay, so much had to happen for this to work out the way that it did. So moving now into 1980. Okay, the Fed by 1980 was resolved to stop inflation. They were going to do anything that it took. Okay, Chairman Paul Volcker was the Federal Reserve chairman at the time, and he basically just kept on raising rates in 1980 and 81. He raised rates till the federal fund rate hit 20%. Okay, 20%. If you had a CD at that time, you could park your money at a bank and make 15%. Shoot, you could buy short-term treasury notes at probably 15 to 18%, like a 2-year treasury note. Okay, so this is just a crazy time when you just try to fathom that. I'm trying to fathom it. I wasn't even alive back then, so I look at it and I just am blown away. This finally brought the economy and inflation to a standstill. Okay, he takes it to 20%, finally to a standstill. Now, so fast forward to today, you guys. Why is this information relative? Okay, this information is relative because the spike in interest rates in the 1980s, or rather in the 70s to the 80s, was due to oil prices. It was due to energy. Okay, the current inflation trend, okay, why we're seeing more inflation again is simply because of tax reform and very, very strong employment and strict lending guidelines, right? Debt to income ratios to have to qualify, which I'll cover that here in a few minutes. So just we're definitely, it's very hard to compare today with what happened then. Okay, so let's fast forward a little bit. I'm going to talk about this slide right here that looks like a different language, but you guys are going to understand it when I'm done. This is the Fannie Mae mortgage-backed security, okay, the 3.5% coupon. Now, this is a screenshot of it back before Trump was elected, and then after he was elected, and then throughout that year, okay, throughout the entire year of 2017. This is an 18-month chart. Now, why this is relative, okay? When the government had to come in and bail out companies in 2008-9, right through the TARP funds, because all these banks lost their butt because they wrote all these bad mortgages and couldn't buy them back, right? So the government comes and they fund Fannie Mae and Freddie Mac. And they actually, I mean, they still own those companies. They're still holding them in conservatorship. But again, so they come in, they fund Fannie and Freddie, and they go back to the traditional guidelines, which were very, very conservative. And if any of you remember buying a property in 2010 and 11, which was the best time to buy, it was very, very difficult to qualify for a loan. Now, what you're looking at, it's the Fannie Mae mortgage-backed security being bought and sold daily. Okay, so to give you guys an idea, each one of these little lines is 1 day of trading. There's 5 days in a week. The stock market's open 5 days a week, right? Green is investors buying this bond, which causes the bond to appreciate, which drives down the yield. If there's more people buying it, then they can afford to have a lower yield. Red is investors selling, and when I say investors, I mean large hedge funds, central banks, right, from other nations. This is, when this goes up a little bit, it's billions of dollars being traded constantly, okay? And it represents a mortgage-backed security. So it's a bond, and essentially it's pools of mortgages, and investors buy $5 million bundles and sell $5 million bundles, and when they own it, it pays 3.5%, right? Fannie Mae 3.5%. Okay, currently we're trading on a higher coupon because rates have gone up, but this is back in 16 through 17. So it's paying 3.5% as they own it. Now, again, green means that rates got better that day. Even though it's going up, it's inverse. So remember, it's a little confusing, but when it's going up, rates are getting better. When it's red and it's going down, investors are selling the bond, causing it to depreciate, which drives up the yield, and it makes rates worse. Number one is the highest price ever paid for a mortgage-backed security. Rates were the best that day than they have ever been, okay? And around that time, it was the election time, and nobody thought that Trump was going to win. I know many didn't. And you get to number two right here on my chart, and what is that day? And again, before I go over this further, I want to explain what these lines are. These are the moving averages. So if you took the average for where this is traded over a long period of time, it will represent one of these lines. The purple line is the 200-day moving average where rates have been over the past 200 days. The dark blue line is the 50-day, the pink line is the 100-day moving average, the light blue line would be the 25-day, and the green would be the 10-day. Okay, why we look at moving averages is because money generally tends to move up and down within a certain amount within an amount of time. And so, the stock market and people that analyze these things created these moving averages to have a better idea of maybe where the course would be in the future. So as you guys can see, we traded down to our 200-day moving average to all of our major trading averages the day of the election, because it was a huge day with a huge result that could come out. And as a result, we hit our 200-day moving average and we waited. Trump was elected. It caused the largest 3-day bond sell-off of all time. I've been in this business since 2004, and I've tracked this stuff the whole way through. I've never left the industry. I've built my business through all of this. So I've been a mortgage banker now this entire time, and I have never, ever seen what happened those 3 days. It was like you didn't want to lock because it was so bad. You didn't want to lock your rate, but at the same time, every day you woke up, it was like the rates were worsening by like 0.25% a day. So very, very dramatic. That was kind of an interesting point of time. And if you ask, well, why were the rates worsening? Let's back up a bit. Janet Yellen, who was our Fed chairman at the time, she had been monitoring growth since Ben Bernanke, and they wanted to see a 2% growth in inflation for wages. They wanted to see GDP, which is the amount of product that we create as a nation yearly. They wanted to see that we're around 2% growth. And why rates went up so much around this time is because until they started to see growth, they were not going to hike the federal funds rate. Well, Trump's out there talking about healthcare reform and tax reform and these policies that could cause a lot of growth to happen, deregulation. Okay. And so when he was elected, immediately, the bond market moves based on 6 months in advance. So they're going, oh, we're going to have higher rates in the future. So everyone's selling their mortgage bonds. And that's what caused, the stock market also is kind of inverse of this. Sometimes if stocks are selling off, bond market will also be selling off. A lot of that has to do with what the Fed's doing. If they're going to raise rates more, that could scare the stock market, and it'll also hurt the bond market. So you'll see them both move in the same direction. Well, around this time, it was very inverse. So when money was moving out of bonds around this time, it was moving into the stock market. Okay. And so you get on over here to number 3, and that's the third rate hike that we had in over a decade. Around that time, though, interest rates started to improve from that point, because if anybody remembers, healthcare was starting to, it wasn't fading quite yet, but it was starting to look like, hey, this guy's talking about a lot of pretty crazy policies, but I don't know if he's going to get anything through. And so you started to kind of see some uncertainty, and bonds love uncertainty. Rates love uncertainty. They love fear, because that's when investors move money into them, causes it to appreciate, drives down the yield, rates get better. So you'll see here, right, from number 3 all the way to number 4, rates continued to improve month over month until you get to number 4 on my slide. That's the day that healthcare was kaput. They stopped going after it. They said, okay, it's not going to pass. But immediately they started going after tax reform. And you'll see the descent, or rather interest rates start to rise through the end of 2017 and until number 5, when you actually had tax reform pass. So now moving on to 2018. So tax reform is passed, right? We had a little bit of a bump in pricing right there before the end of the year, like, oh yeah, rates are going to get better. No, get into the beginning of the year, bam, straight line down, automatically trade back to the worst rates in about 4 years. And then from that point, we just kind of worsened as the stock market hit all-time highs. It was a pretty phenomenal year. I've never personally woken up to my retirement account going up as much as it did that year, and it was pretty exciting until, of course, we got towards the end of the year. Okay, so now we get over to number two. Number two is a little bit after stocks hit an all-time high. And let me give you a little bit of a background on Jerome Powell, who is our new Fed chief. Around this time, after Trump was elected, he ended up putting Jerome Powell in place. Okay, and it's because they got tax reform through, and they needed a market professional to be able to navigate through the effects of tax reform. Let me give you a background on Jerome Powell. Jerome Powell is not an economist. He's the first Fed chair of all time to not be an economist. In fact, his background is in venture capital, and he has a law degree. Okay? So why would they make him the chair of the Federal Reserve? Because he's a market pro, and he knows how to navigate through things and stress test the economy. And that's what I believe he did with rates this last year. So this whole time after he was elected, for about 10 months, he this entire time, what he did, he followed the same pace as Janet Yellen. He wanted to see about a 2% growth. Okay, and he was very patient on how he would address the markets, and everything that, whenever there was a live press conference and he came out, he kind of followed the same suit as Janet Yellen. And as that happened, the stocks kept going up, right? Interest rates kind of just kept on worsening because the Fed came out and they said, hey, we're going to put 2 to 3, maybe 4 hikes on the table for this year, but we're going to monitor growth month over month. You saw wage inflation between 1 to 2 on my chart. You saw wage inflation start to go up month over month to where we actually hit a 2.7% month over month growth. Okay, year over year, we were over about 2.5%, far above where we were ever needed to be when Janet Yellen was still the Federal Reserve chief. But because tax reform went through, they automatically expected there to be higher growth, and they were okay with that as long as it didn't get too red hot. We'll fast forward to number 2. This is the day when Jerome Powell came out in September of last year, and he essentially told the markets, hey, you guys, we're nowhere near neutral on our federal fund rate, which they had hiked this rate that was 0 to 1/4 all the way up now to almost 2%, which is what the Fed's target was before Jerome Powell. And you now get there, and he tells the whole market, hey, guys, we're nowhere near neutral. We're going to have to hike rates 4 times this year, so 2 more hikes on the table, one coming up and then one in December. And then we're also going to have to do 4 rate hikes for next year. And we're not even sure where the neutral rate is. It could be 3.5%. When he told the markets that, you automatically saw stocks worsen from that point. Okay, and you saw interest rates hit, if you look at my number 3, that's the highest rates we had in over a decade. Interest rates hit 5.125% on a 30-year fixed mortgage. You could have Googled Wells Fargo mortgage rates today and seen what they were posting. They were posting a 5 1/8. So pretty unbelievable. Fast forward now, interest rates got to a point where they were at the worst point, but it started to scare the stock market dramatically, where you finally started to see money move out of stocks and move directly into bonds. So I have on my next chart, you'll see this is the S&P 500, the 500 biggest companies in the United States, and essentially them as an index, how they had performed from Trump. You see here, we were trading at around, actually below 2,000 when he was enacted. And then we went all the way up to, 29,040. And then right after Jerome Powell came out and gave those comments, we sunk last year to where the S&P ended negative by about almost 7%, after being up, like 15%. So those were very, very dramatic comments that were made. And then you see here, as we get into the new year, money moves right back into stocks. Okay. It's like he literally came out last year and stress tested the market to see what would 5% rates do, how would it slow things down. It's just fascinating when you look at it the way that I see it here. So again, we get through here at the end of the year. Number 4 and number 5 would just essentially be, where we were trading towards the end of last year. And now from that point, interest rates are, after today, they're at the best levels really that they've been at probably since about 12 months ago. So definitely in a very, very good position. And I'm going to go over that here next and really what that's entailing. So in order to figure that out, we go back here. Number 4 is when the Fed raised rates in December last year for the 4th time for the year. And what they did is they didn't come out with a very hawkish tone or a dovish tone. Hawkish means they're more aggressive on their stance for raising rates because they see a lot more growth ahead. Dovish is more patiently waiting on their approach because they're not seeing enough growth, right? So dovish means less rate hikes ahead, hawkish means more ahead. They gave kind of a neutral comment to the market, not really what they wanted to hear. We all knew that it might have been just trying to kind of puff up and act strong, but the growth really wasn't there, and that kind of showed its face as we got it here into the new year. So what they did is they put two rate hikes for 2019 on the table on their dot plot chart, and they raised rates in December of 2018. Okay, they also stated that more hikes would likely be warranted. So further gradual increases is the verbiage that they used. They said they would be patient in their approach to raising rates in 2019 based on the growth outlook on a month-over-month basis. So what changed in 2019 versus 18? In 2018, 17, and for many years before, the Fed can raise rates every single month if they want to, but they only have on average 4 live press conferences a year. Okay, they do them on all the major quarters: January, March, June, September, and December. They never raise rates in January. Okay, it's always only one of those quarterly months. And they do a live press conference because they feel that they need to justify to the markets, right, why they're going to increase rates. And it's kind of been a rule of thumb that you've known that they're not going to hike on any month in between either March, June, September, or December. So what changed in 2019? They are now doing a live press conference every single month. Example is today. They did a live press conference today. Okay, they would have never done that in January before. So they are going to be much more closely monitoring what's happening with the economy this year, okay, than they have in the prior years. And I'm going to discuss a little bit more why here in just a minute. They also stated we were on the lower end of their neutral rate. So they said that the 2.25% to 2.5% that our federal fund rate is now averaging at, that's the lower end of their neutral. So meaning that 3% might be kind of the higher range, right? Like, so maybe 2 to 3 more rate hikes might be warranted, but that we were basically on the lower end of their neutral rate. They also said that they would continue to trim their balance sheet by not reinvesting the money from maturing bonds and mortgage-backed securities back into the securities. So if you guys read my article that's on the Marsh Reddick website, you guys will get a lot more detail on really what that means. But basically, if anybody remembers QE1, QE2, QE3, that was quantitative easing, those 3 rounds that they did, where the government was buying billions and billions of dollars of mortgage-backed securities, right? Mortgage bonds and treasury notes, right, to create an artificially low interest rate environment. Well, they amassed over $1.7 trillion of mortgage-backed securities. What they've said last year is they said that we're going to start letting those roll off. So as they mature, we're not going to take the money and reinvest it back into the mortgage-backed securities. We're just going to not buy with that money, and we're going to slowly let it roll off. And as that happens, the Fed will back out of the market. And if they're not buying mortgage-backed securities, somebody else will need to. And those some other people might require a higher rate of return than what we're seeing around that time and what we're seeing currently. And so that's kind of the worry there is, are they going to start to reinvest again? Are they going to keep money in the economy, or are they just going to let themselves back out completely? So that's why the long-term outlook for interest rates is actually a lot higher than the current trend that we're in right now. But they changed some verbiage on that today, which is pretty exciting. I'm going to go over that right now. So the key points from today's Fed announcement. Fed Chair Jerome Powell says the case for raising interest rates has weakened. Yes. The central bank instead said it will be patient as it determines what future adjustments to the target range, meaning that they're going to be patient in determining if 2.5% is actually the bottom end of their neutral rate for the federal fund rate, meaning that they don't know what that neutral rate is right now. They think that it might even be where we're at right now. We might even be a little bit above that rate. Okay, so that was very, very important verbiage that they brought out. The Fed dropped the statement language that more rate hikes likely will be warranted, which is excellent. And then the officials in that statement also said that they expect to operate with an ample supply of bank reserves. That's the statement that we wanted. That means that they are going to operate with potentially reinvesting money into the banking system, right, by buying mortgage-backed securities, because they're starting to realize that if they back off the pedal too much, okay, we could see a situation where when they're out of the market completely, the financial systems will have to adjust to them no longer being there, and that could cause our next Great Recession, okay? Nothing like the one we just had, but it could cause a recession, folks. So that is a very, very key statement that was made. Now, what to take out of this, okay? What changed in the Fed's policy statement today? These are the key points. The Fed dropped language that more rate hikes would likely be warranted. They dropped it. Remember they said further gradual increases at the last meeting. Well, today they replaced it with case for raising rates has weakened. That's good for interest rates. The central bank said it will be patient as it determines what future adjustments to the target rate. That was a big thing to take away. Officials in that statement also said they expect to operate with an ample supply of bank reserves, meaning reduction in MBS and Treasury holdings will be weighted versus a strategic path. Before it was, nope, one way or the highway is what we're doing. Now they're going to start weighting it month over month. If they don't get the growth that they want this year, hey, maybe they start reinvesting back in at a certain amount every single month out of those MBS. And this thing goes a lot longer, which gives us more time to recover and us a lot more time to get safer before they're out of the market. The central bank voted unanimously to hold its policy rate in a range between 2.25% and 2.5%. Yeah, we expected that. Okay. Having fun? I'm having a lot of fun right now. Okay, what to expect for interest rates in 2019? Without the tax reform windfall, companies are expected to report more modest growth for 2019. Okay, quality stocks like the S&P 500 that I just showed you, it's expected to outperform. Okay, these are the strongest companies, right? Even Apple, right? They put out some news that, oh, you know, we're seeing slowed growth in our iPhone usage, blah, blah, blah. Yeah, right. It was up over 6% after hours yesterday because they blew away earnings. Okay, Facebook, same exact thing today. Okay, if it's a strong company with good fundamentals, they probably used all that tax windfall to grow their company, and they're going to have good earnings. But quality stocks are expected to do well this year. The market as a whole is expected to show more modest growth. Okay, which is good for us. We want 2% growth. We don't want this 3.5%, 4% growth. So job growth is expected to continue improving, with the unemployment rate hovering in the mid to upper 3% range. Wage inflation is expected to be in the 2% range. That's the Fed's original healthy target rate. And unless we see a surprise in wage inflation growth, I don't expect the Fed will raise rates in 2019. Futures, which bet on this specifically, are pricing in 0 rate hikes into this year. Okay, so how are politics affecting the markets? And anybody that experienced the government shutdown, I am so sorry that you had to go through that, and I'm really hoping that something can get, a deal can be struck so it doesn't happen again within 3 weeks. But I'm gonna kind of cover these things and how they're essentially affecting interest rates and affecting the market. So trade war. Okay, I think companies are more afraid of trade war dragging out than they are of the actual results of the agreement. The trade war creates tremendous uncertainty. Okay, now that's helping interest rates, right? Because bonds love uncertainty and they love fear. But it's hurting the stock market. It's also beginning to hurt consumer confidence. We saw consumer confidence numbers come in significantly lower than expected. Still at 120, which is fantastic, but you know, it was lower than expected. And you know, as this thing drags out further and further, you know, investors and the Fed, they're just more worried about the long-term effects of this if they don't strike something soon. Again, any agreement at this point will be better than nothing. I mean, unless of course it was just, well, again, China would never agree to it if they didn't agree to it. So again, any agreement would be good at this point. If this travels on too long, they've even talked about it might even start a Cold War between China and the U.S. I just don't believe that. But again, the longer that drags out, the more uncertainty, better it is for rates, worse it is for the markets. Government shutdown. You guys, this was the longest government shutdown in U.S. history. Another shutdown is expected in less than 3 weeks if a deal is not made on the wall. Okay, this uncertainty, I mean, we already know how it's affecting the markets. It's potentially cost the markets and the U.S. taxpayers about $11 billion. and it caused a lot of other issues personally for those folks, which we're very, very sorry about. But even from a dollar money standpoint, it affected us in a way where there's even data that we don't even have right now because of certain parts of the government being shut down. So it does have a very big impact. And it's that uncertainty is actually helping mortgage rates. So in the short term, it's helping our interest rates. But yeah, just definitely having an impact on the economy, and hopefully a deal can be made on that. Brexit. Brexit is another thing that's really affecting more of the geopolitical out there. And if things around the world are not going so rosy, the Fed is more apt to not raise rates quite as fast either, because they don't want to get ahead of the rest of the world. Okay, they want to still be kind of in line with the rest of the world. So what goes on around the world, also, if there's something negative happening in another country, a lot of times they will buy our mortgage debt as kind of a safe haven. It pays whatever 4% rate, and it's secured by all of us U.S. people that are qualifying with low debt to income ratios and buying with money down. It's not like it was back in 2009 and 10 when if you own mortgage-backed securities, you're probably losing your tail because people weren't making their payments. That environment's gone. So you see that Brexit, which stands for British exit. Okay, this is the word used to talk about the United Kingdom's decision to leave the European Union. Okay, Brexit was announced on June 23rd of 2016. About 51.9% of those people who voted supported the withdrawal. And now you fast forward 2 years later, and the plan for how they were going to exit was just rejected earlier this month. So they're working on another new plan, but it's not expected for Brexit to start, assuming that this new plan does go through, until March 29th of 2019. So between now and then, this uncertainty that's out there is impacting mortgage rates. It's keeping rates lower because of the uncertainty over Brexit. So that's essentially how it's affecting the markets. Other than that, we don't really get any, direct effect from this, other than the fact that our rates are a little bit better, a little bit more elevated, meaning better than they would be if Brexit was already handled. Okay, and then again, interest rates should continue to stay low if uncertainty over these major issues is not resolved. Quick question. So I know that you guys are able to answer this. What is the highest 30-year mortgage rate in history? And if you just get the actual percentage, I think I put the actual 4-digit math on here, but if you just get the percentage, then you're right. What is it? 18.63%, 1981. What is the lowest 30-year fixed rate in history? And some of you may have gotten a rate lower than this, okay, but that would have only been because the bank that you're with, maybe you have a lot of money with them, millions of dollars or something, and they wanted to get you a rate that's lower than what was being offered to anybody else. And that did happen. I know friends that got, I think, a 3% 30-year fix. But lowest rate that was advertised nationally was 3.21 to 3.31%. That was in 2016. And I actually showed you guys that day when pricing got elevated to that level. Okay, now moving on to what factors are helping to fuel the real estate market. It's jobs, jobs, jobs. Okay, this is a stat from the Bureau of Labor Statistics. You see your unemployment in 2009 in October got to 10%. Okay, you fast forward to today, December, 3.9%. So something else that I want to point out here is you're like, well, Reed, what if you're getting to like full employment, or like when's it going to start contracting? Okay, well, explain this one to me. The JOLTS report. It's the Job Openings and Labor Turnover Survey. Okay, this survey shows there are currently 6.88 million unfilled skilled labor jobs. Okay, this is not flipping burgers. This is like skilled positions. This is it's not just skilled labor jobs. It really should say skilled jobs. These are jobs that are $80,000 a year, $200,000 a year. This is mainly due to baby boomers exiting the workforce, okay? And what you're going to see here, and why we've seen already some more inflation in wages was partially because of this, is you see that there may be one job, or rather 10 jobs available, that only one person can fill that job. And as a result, different companies have to hire, or rather they have to offer higher wages to maybe take Google or some Google executive away from Google and bring them over to Facebook. And as a result, things like that are happening, and it causes some wage inflation. But overall, why this is important is that it shows that there's still a lot more that can be done within the labor force. And as baby boomers exit the market, skilled labor workers will move into their place. So it's safe to say employment still has several years left in the current cycle until we reach full employment. The other reason this is dramatically affecting real estate right here, you guys. This is what's helped to fuel it, in my opinion, since 2010, is borrowers have to qualify with a debt-to-income ratio that they have to prove. And in 2005 and 6, you could fog a mirror and get 10 loans to buy 10 investment properties. You'd fill out an application. You could work at Home Depot and write that you're a manager and that you make $15,000 a month. And nobody would question it. You had to supply no documentations to prove it, okay? And so what happened was the government said, well, hey, if we're going to be buying all these mortgage bonds, because we bought Fannie Mae and Freddie Mac and we bailed them out, we're going to bail out the U.S. government right now from a mortgage standpoint, then we want to make sure that these borrowers can afford their monthly payment so that this does not happen again. So debt-to-income ratio, for example, if you're making $10,000 a month in W-2 income, just for example, and the monthly payment, you have no auto loans, no minimum payments on credit cards, no student loans. Let's just say that you have no monthly debt, you pay it off every single month, but the monthly payment for the home that you're going to buy with principal, interest, property taxes, homeowners insurance, maybe there's an HOA. Let's say that monthly payment is $4,000 a month. $4,000 divided into $10,000 would mean that you have a 40% debt to income ratio. If you have an auto loan, that would be added into the equation as well, or any other loan reporting on your personal credit. You cannot go above 49.99% debt to income ratio and qualify for a conventional mortgage loan. Conventional loans have the lowest interest rates, lowest down payment requirements, right? And up until about 2016, you couldn't qualify above a 45% debt to income ratio. They just loosened up because the economy got better over the last 3 or 4 years, okay? But literally, for a long time, you had to be below 45%, okay? So the debt to income ratio has created a market for mortgage-backed securities where investors buy the mortgage-backed securities again, right? Investors lend money, right? Marshall Reddick does a lot of private lending in this way. If you go on there, you can go and buy notes. You can be the lender. You can be the bank, and you can feel more confident, right? Even in that case, they're not verifying income and assets, but on those types of loans, the difference is they might not make you verify DTI, but they're making you put 40% down, right? So the types of loans that have been getting created over the past several years have either been full documentation loans if you're putting a minimum amount down, or if you're doing private financing, private lenders are requiring a large amount down because if you stop making your payments, they want to take back that property and have equity there to work with. So as a whole, the real estate market is just so much safer, so much more stable than it was back in 2008. Now, the other main things that are helping to fuel the real estate economy. So the Fannie Mae loan limit, okay, nationwide in any market was $417,000 since 2006. And there were certain markets called high-cost markets, like Orange County is one of those, Los Angeles County, where you could go to a $626,000 loan amount if it was a high-cost market. Okay, so again, though, let's look at this more nationally. It was $417,000. So in 2017, after Trump was elected, because he's talking about all this stuff that might go through to grow the economy, might have higher wages, right? Fannie Mae decides to raise their loan limits for the first time in a decade. Okay, they only raised it to $424,100, so about a 3% increase. Actually, excuse me, less, about a 1.7% increase. So not that big of an increase, but hey, they started to see some, little bit of growth in wages, and let's just take a chance here. Okay, fast forward to the next year for 2018. Okay, because tax reform goes through. They increased the Fannie Mae loan limits by 6.8%. Now, in a high-cost market like Orange County, if you see here, number one, the 679, 650 loan amount, you can now do a 5% down loan to a $679,000, 650 loan amount, And if you're a primary borrower, you're buying in Lake Forest, you're going to put 5% down, you're making good money, didn't have a ton of money saved yet, but you have a great W-2 income, great credit scores, you could buy a single-family home and put 5% down. you know? So as they raised this loan limit, it opened up the market for more buyers to get the best type of financing if they had the right type of qualifying criteria to do so. You then fast forward again, 2019, another increase by 6.8% again. So now you can go around the country. What's great, if you're investing in areas like San Antonio, that's, you know, it's just historically, it's a cheaper place to live than the average, but a great market to invest in. Okay, you might not need $484,350, but surely the fact that that loan is available to that amount is going to create more buyers in any of these markets. And you see now here in Orange County, you know, if you're going to buy here, you're going to buy in the Bay Area, you can now do 5% down to a $726,525 loan amount. Okay, so by Fannie Mae increasing the amount that they will borrow, it's just allowing more and more buyers to get in. So what's expected over really about the next 10 years? So I kind of wanted to, you know, I found some great stuff on the Bureau of Labor Statistics. That's kind of where I shop when I get information, because it's straight from the GOV, and it's usually very, very accurate. The civilian labor force is projected to reach 169.7 million in 2026, growing at an annual rate of 0.6%. This growth is slightly faster than the annual rate of growth, which has been 0.5% witnessed during the 2006 to 16 decade, but slower than the annual growth experienced during several other decades prior. Why is that good? We don't want out of control growth. We want the government to stay involved until we are so far out of the woods that it doesn't matter anymore. So by this growth, with the outlook the way that it stands right now, and with tax reform kind of being behind us, okay, hopefully the growth will stay at around 2% this year, and we will just have very slight rate hikes moving into the next few years. And if we hit a position where we're moving into a recession, then they can lower rates a bit, right, to stimulate the economy again, and then it'll go through another cycle. So the fact, though, that the labor force is projected to continue increasing because of population growth is awesome. The average national appreciation rate for real estate over the past 70 years, folks, is 4.76% year over year. Okay, if your asset's going up 7% a year over a 10-year period, rule of 72, your asset will double in value. Okay, the great part about real estate is you don't have to buy that property cash. You could put 25% down, right? 30% down. But if the asset's going up 4.76% a year, your return's much higher than 4.76% because you didn't have to buy it cash, right? So real estate is not only the safest investment over a 70-year period, it's also the most profitable and the only investment that you can leverage in the way that you can leverage it. So, and while rates are this low, just great time to get back in. You know, you're probably up around higher 5% range at the worst point for investment property financing. You're now down in the low 5 with a little bit of rate buy down, maybe even the high 4s. So employment will drive the real estate market for years to come. Employment is projected to increase by 11.5 million over the 2016 to 26 decade, an increase of 156 million to 167.6 million. This growth is 0.7% annual. And I just went over that on the previous slide, but healthcare industries and their associated occupations are expected to account for a large share of new jobs projected through 2026. As aging population continues to drive demand for healthcare services, the labor force will continue to grow slowly and to become older and more diverse. The aging population is projected to result in a decline in overall labor force participation rate over the 2016 to 2026 decade. So slower growth. Okay, this has been a lot of fun, you guys. There's a lot more information too. I wanted to kind of go over the inverted yield curve everybody's talked about that we saw on December 3rd, the end of last year. And usually whenever that happens, it can be a precursor into a recession. But you saw that correct itself. You actually saw the 2-year note today drop significantly to around 2.51, the 10-year at about 2.66. So we're not inverted. It's still on the right path. But there's a lot more here also to talk about, folks. So if you guys want to be included on my weekly market update, it's totally free. It goes out every Saturday. It's a lot more information than just this, and it's emailed to you. So if you guys want to be included, send me your information. Say, hey, Reed, put me on your market update. And if you guys want to have a conversation to talk about this stuff more in depth, I'm pretty much always available. You guys can call me up anytime. And what I'm going to go over right now is just the process to get pre-approved. We've done this in 3 easy steps. So it's not very difficult. And getting pre-approved and getting pre-qualified are two totally separate things. Getting pre-approved is, I want to get to a real estate advisor, Marshall Reddick, right now to start looking at my options in these different markets to build a game plan, and I want to start placing offers. Or I already want to buy in San Antonio, Texas, and I need to get a pre-approval letter. Okay, or I'm very serious about buying in the next 3 months. That's a pre-approval. We're going to run your credit, get all your documentation in. Okay, we're going to do an underwritten approval for free here at my office with my underwriter. We'll then send over the numbers for review with 20%, 25% down as a starting point. We'll send you an approval letter, and then you guys can start placing offers when you find the right property. Getting pre-qualified, we do not run credit. We get in your documents, we get in your application, we get you prepared to be able to move quickly if we need to, but we basically don't run credit, and we tell you what you're qualified for, essentially like how high you should be able to go. You can run your own credit report so we can find out what your debts are and supply that to us. But that's the difference between getting pre-qualified and getting pre-approved. It's just, we're not going to run the credit if you're just getting pre-qualified. Getting pre-approved, it will be good for 120 days. If you're not looking to buy for 4 to 6 months, we will not run credit, just get pre-qualified. The process will take about 24 hours to get it completed. And if you want to buy more than one property at once, I mean, we have investors that are doing 1031 tax-deferred exchanges where they're selling a property, maybe a fourplex, and buying 2 more. We actually just did one that had 6 properties all done at one time. So you can definitely get approved to buy more than one property at once. And when we run your pre-approval, we'll base it on the max amount that you qualify for. Just some online reviews, just to kind of take a look at us. This is my partner, Al Rodriguez. That's me. Amy's one of my loan officers. We're located in San Clemente. We're about 20 minutes from the Marshall Reddick main office in Newport. And if you ever want to meet in person too, I'm happy to drive up there and meet with you. This is all of my contact information, you guys. And I hope that you really enjoyed listening tonight. I hope that you guys got something from this. I just, I truly have a passion for tracking this information. I love what I do. I love my company. I love my family. I love Marshall Reddick. And I'm so happy that you guys were all here tonight to listen. You guys have a great night. And I'm going to put it on back on over to Daniel.
Reed, thank you so much for an incredibly informative webinar. I know I just learned a ton, and I'm sure the rest of the Marshall Reddick clients on the webinar did as well. Guys, thank you so much for joining us on tonight's webinar, taking time out of your Wednesday evening. Reed and I are more than available to discuss further, answer your questions. All of my contact information is available right here on the screen. Reed and I will certainly be following up, but if you'd like to reach out ahead of time, feel free to reach out to myself, reach out to Reed, so we can start the conversation and get to know a little bit more about your real estate investing and financing needs. So thank you all once again, and hope to see you on another webinar soon.
Thanks, you guys. Have a great night.